It's an absolute honor for me to be talking to accomplished audience like this today, and more so in front of the captains of the mutual fund industry. And I'm so delighted that all the mutual fund representation have been my clients at different point of time, and I have extended direct coverage to them from different platforms. Today, I would begin by my view on the world. The world looks in a very good spot. US is looking on a very good steady clip of 2.9% real GDP growth. The Fed has referred to the GDP growth there first time, the second time, frankly, since 2000. They have referred to the economy as growing strong. The only time after 2000 was in 2006. So US looks very good. The US is not overheating because the Fed is going pretty steadily on raising, and therefore the overheating, if that happens after a strong economy, is a little bit away. Europe may have seen its worst, and at 2.1% real GDP growing, that gives us more confidence. Now, China and trade wars, there is a lot of talk about it, but still at real GDP of 6.6%, China doesn't look bad. Now, what's the real fuss and cry about? The real numbers talk of a different story, and I would want to look at those numbers back home in India and see how it's unfolding. So, for the ease of this conversation, I have divided the time frame between 3 years before the demon and 1.5 years after the demon. So let's take calendar 14, 15, and 16 and how industry fared, and 1.5 years after demon. The big question in the minds of most investors today is who's going to be funding the growth for corporate India. And if you were to look at it on 3 parameters, which is raising from the primary market, corporate bonds, and bank credits. So there is a very interesting look that one took on it. In primary issuances, the first 3 years before the demon, which is calendar 14, 15, and 16, the raisings, and that include the QIPs, IPOs, and the rights issuances, was 3,100 billion INR. And that was over calendar 14, 15, and 16 over 3 years. The same number after demon, and if you take it from beginning of 2017 and year till date in 18, it's 3,000. Now, strikingly, it's 100% growth. What we did in 3 years in terms of raising has been achieved in just 1.5 years. The stock market participants have definitely supported it. And it also gives you an indication of the appetite that the industry has at this point of time. Look at the numbers for the industry bonds that have come in. The first 3 years before demon, it was 12 trillion INR. And the 1.5 years after that, it's 11.6. So 11.6 done in 1.5 years against 12 done in the 3 years before the demon. Now that's a stupendous 95% growth. The third engine of sourcing funds for the corporate India is the banking industry. Now that is the only area which has not grown. Now if I were to look at the real numbers, and these are all verified numbers, bank credit has grown only 2% over this time frame. So 14, 15, and 16 calendar, the bank credit was 935 trillion INR. And if you look at 17 calendar and 18, it's 473 trillion INR. So whereas the primary issuances have grown 100%, the corporate bonds have grown 90%, 95% actually. The bank credit hasn't grown that much. We should also look at a very important data point for our industry, and that's deposit in banks. So going by the same time frames, I have taken the deposits with banks on 7th November 2016, which was at 99 trillion INR. And if you look at it on 31st March 2017, it jumped to 108 trillion INR. Now that's a fabulous 9% growth in deposits over 4 months' time. It's a very important data point for us. July 18, it's 114, which is slowed down, and it's just 5.5. Now, actually, this gets us to the second most important question that we have in mind, and that is, have the 500 and 1,000 rupee denomination notes seen their way into the banking system very fast in a short term post-demon? And have those funds got channeled into the mutual fund industry after that? Well, my understanding of the money is that it goes and drifts towards the place where there is higher returns. And look at the different asset classes. Mutual fund is the highest return instrument today. So yes, there is a very strong chance of that money building up and getting funneled and channelized into the mutual fund industry as of now. These two takes get us to some very interesting discussions that people may be having in Raffles Place or Manhattan about Indian growth, and the answer does not lie in the bank credits because of the turbulence that we've seen so far. The answer may not lie fully with the corporate bonds as the interest rates increase. So while we've done so much better in last 1.5 years, the next few years could be even bent towards the mutual fund industry for the attractiveness of the returns that they offer to us. These two questions have also been discussed when you call this a Clarke chatter in Singapore and a Victoria Harbour chatter in Hong Kong as to who's going to be funding this growth. So this data point suggests very clearly in favor of the mutual fund industry. Now, if we were to come back on the primary issuances, and if we were to believe that in last 1.5 years, the growth was 100%, and even if that growth just flattens out, zero growth, the primary issuances will see an appetite from the industry of 10 trillion INR over next 5 years. Now that is the appetite which is at zero growth. Put that number to 20%, and the appetite for the industry in next 5 years from the stock markets as a whole, not just mutual fund industry, would rise to 25 trillion INR. Now that's a huge number. That's a huge, huge number. And I would guess, unlike in the past, now the boardroom discussions overseas would focus about who's funding the growth for corporates in India. And the only answer that we see is pointing towards the stock markets and largely towards the mutual fund industry. And that's all I had to say right now. Thank you.